historically, investing pays off. Now, it isn't always that way. Just take a look at this year as an example. We had a heck of a run. Let's just put things in perspective where we are right now with things. We are bouncing around between 23,000 and 25,000 on the Dow Jones Industrial Average. That's sort of that range we've gotten into now. We're right at 24 today. We were down 200 some odd points today. In the last 24 days, there have been 20 days where the market has either been up or down 100 points. Okay? That sounds like a lot, but 100 points on the Dow is like 0.2% maybe. Percentage-wise, it's nothing. But there is still something in people's minds when they see the market going up or down 100 points or more that thinks that there's really dramatic things going on. But again, okay, this has not been a great year for investing. If you take a look at the Dow or the NASDAQ, well, maybe not the NASDAQ, but the S&P 500, we're down a little bit for the year, okay? But we're coming off a heck of a strong run going back to 2009. But even this, you go back let's go back 16 months ago. The Dow was at 18,000. It's at 24,000 right now. That's pretty good. Okay, that's been a pretty good run. Now it's kind of choppy. Let's go back to 2009 because we were just coming off the Great Recession. And I mean, it was a toughie. It was a toughie. You probably experienced either at work or in other ways, you probably experienced the damage that was done in this country when we went into that Great Recession. The housing market had crashed and just all kinds of stuff going on. Oh, we'll talk about housing too. I love to talk about housing. 2009, and I'll even go back a little bit further. In 2000, we had the dot-com bubble crack, blew up. I mean, just blew up. Anything that had a dot-com, for the most part, behind its name, just was gone. There was, anybody remember Pets.com? Anybody remember Pets.com? They even bought an ad on the Super Bowl. And they had the sock puppet. That was their big thing. There was never a company there. There never was really a company that sold pet products. And it got up to $125 a share. And when we had the dot-com bubble blow up, it went out of business. It disappeared, as did a lot of other companies. So we recovered from that pretty strong. And by 2007, the Dow was up to 14,000. Okay? A year and a half later, the Dow had lost more than 50% of its value. We went back down to, on March 9th, 2009, the Dow was back down to 6,547. It's weird that I remember that number so well, but I do. 6,547, from 14 to under 7,000. And I don't know what the heck happened on March 9th, but that was when it all ended. That's when everybody was getting out. Everybody that was getting out had gotten out, I guess, by that point. And we kicked off this enormous rally that has taken us to 26,000, almost without interruption, because there have been a lot of fits and starts along the way, and it hasn't been a straight line. And we're learning that the hard way right now, that if you're an investor, you better be ready for some of the ups and downs that happen with the stock market. So you've got to kind of keep all of that in mind as you become an investor. And I hope, regardless of your age, that all of you either are investors or will become investors, because it really behooves you to do it. That's how you're going to take advantage of growth that the stock market provides. And I know it's scary sometimes. Wayne Gretzky once said, and you don't usually hear Wayne Gretzky talked about at financial meetings like this, but Wayne Gretzky once said, you never score a goal if you don't take a shot. And that's kind of the way that I approach investing. Now, I don't expect you all to go out and take all your money out of CDs and annuities and stuff like that and put it in the stock market. No, you shouldn't do that. But you should have some money in the stock market to get you through these tumultuous times. And one other thing on the millionaire thing, I left all my notes at the radio station today, so I'm just kind of flying by seat of my pants here. Probably the best book on money that's ever been written is called The Millionaire Next Door. It is a magnificent book. It's also probably the most boring book you will ever read on personal finances. It is a massive yawner. There is nothing funny about it, nothing exciting about it, no great tips in it. It just says that if you want to be a millionaire, you have to do one thing, and that you have to be frugal. You have to live a life of being frugal. And if you do that, you will become the millionaire next door. I can guarantee you, no matter where community you live in, what city you live in, any part of San Diego County, somewhere probably on your street is a millionaire. But you wouldn't know it because they're driving a car that's 12 years old. Okay? It looks like they wear the same clothes every day. Okay? And they lead a very low-key life. But they're doing fine because they lead a life of being frugal. And if you don't know what that means, pick up the book. It's a gem. It really is a gem. You can usually find it in the bargain books section at Barnes & Noble for some reason. Every time I go through Barnes & Noble, which I love to do.